My sense is that we've kind of hit the bottom, meaning things are not worsening anymore.
Right.
And as government spending is now hitting the economy and the RBI's end of quantitative tightening, so we called it in late August when we last had the conversation that by keeping, so what we discussed then was that overnight liquidity was kept in surplus for a long time. And now this has started showing up in deposit growth being. So as these things play out, I think by maybe Feb, March, we should start to see the economy, the high frequency indicators improving meaningfully from here. So there is a very visible slowdown.
Right.
And you can see various signs of that. So everything from cement volume growth to auto sales, both four-wheelers, two-wheelers, commercial vehicles, consumer goods, and credit growth, we have seen a very sharp decline in system credit growth. There is significant rise in non-performing assets at the retail level. Many microfinance, small businesses are really struggling. And you can see that the steady upgrades to India's growth forecasts are now turning into downgrades. It's not just that we saw the 5% odd growth accelerate to 7% odd growth in consensus numbers, and then it stagnates there because India is not accelerating anymore, but it kind of is topping over, and now we are starting to see cuts. We are starting to see earnings projections cuts in the stock market. So just in the first 20 odd days of this earnings season, generally lasts about 30-35 days, we have seen the BSE 200 earnings fall by more than 2%. Initially, these cuts were only for FY25, this fiscal year. We are now starting to see cuts to FY26 as well.
Right.
That people are now bringing down estimates for the next year as well. So this is clearly a very widespread slowdown. So there are fiscal reasons and monetary reasons.
Right.
And we've often discussed on our open dialogue chats that there are structural growth trends and you can manage cyclicality through fiscal and monetary tools.
Right.
Now, if you increase your fiscal deficit, it boosts growth. If you reduce your fiscal deficit, it takes away from growth. So India is still consolidating fiscally. So the state government deficits, I think, will be flattish or maybe marginally up or down. But the central government deficit is expected to fall from 5.6% to 4.9%. So this is the same pace of consolidation that we saw, or similar pace of consolidation as we saw the previous year, where it fell from 6.4 to 5.6. So 70-80 basis points, I think the economy has enough cyclical momentum that it can absorb. But what happened because of the elections is that after, I think, late February, when the Model Code of Conduct came in, the cabinet meeting stopped. So the file stopped moving. And then for the next 3 months, there was no government because the elections were going on. And then it takes about a month for the ministerial positions to be announced. The ministers come in and then they start pushing their agenda. So there is a 4-5 month lull where the files didn't move. So when the files start moving, then the expenditure starts happening. So that's one reason. I think there is a second factor, which is that in some of the critical ministerial, like bureaucratic positions, there were personnel changes. So it's like, new batsman on the pitch, wo pitch ka jaiza le raha hai ki wo, how the files move, which is important, what is not. Generally, officers are very capable of, because they're used to getting transferred and adapting to new situations, but still takes a couple of weeks, couple of months. I think the government is now wiser to this. So basically over the last month and a half or so, I think sufficient feedback has gone to the government, the finance ministry, that we need to accelerate the pace of spending. And we saw just yesterday, like early November, the finance ministry officials making explicit comments that we will meet our spending targets this year.
Right.
So, which means that in the first 5 months, central government capex was down 19% year on year. In the month of September, which is the 6th month, it was down 2% year on year. So it is not up yet, and the full year number is supposed to be up 11%. So, which means that in the second half, if they really meet their capex targets, you're going to see 30-35% growth in the spending. So as these things play out, I think by maybe Feb, March, we should start to see the economy, the high frequency indicators improving meaningfully from here.
The short-term factors have obviously reversed. One question is whether they've reversed quickly enough and have they left some residual impact or not, which we will only see over time. There are some external risks to growth, particularly what happens in the US and do global interest rates rise, which could result in some outflow of capital. Also, some events in China could cause contagion effect and create issues for us. But otherwise, if these things, don't kind of happen or don't happen at a very rapid or a large scale, India seems poised to kind of come back to the growth trajectory.